This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the show, I have Mark Rzepczynski. Mark is with AMPHI Capital. Mark is also partners with Perry Kaufman, who I've had on the show recently. Mark has got a long, distinguished career. He has seen just about everything in the portfolio management arena. From being at the CME to working with John Henry, he's seen it all. A really interesting conversation, digging deep on the notion of risk, uncertainty, complexity, returns, and a lot of trend following. I hope you enjoyed this conversation. Yeah, I was thinking it was probably 2005, I think.
It could be that long. So it's. I remember you coming down to Florida, being in our offices down in John Henry, and I know I've been following you and checking on all the things you've been doing, but we haven't really sort of connected it as much. So you're a busier man than me.
Well, I don't know about that. It's like, let's see. Hold on, I'm going to go down the list. Professor, economist, fund manager, portfolio manager, JWH, FIA, CTA, CPO, Merrill, CME. Did I miss anything?
Yeah, no, I think you got it all.
I think you're a pretty busy guy too. Hey, listen, I wanted to jump in something. We were kind of texting a little bit there on Skype. And you're a guy that's been interviewed an absolute tremendous amount of times. And we were just kind of like a quick exchange of text messages about why podcasting is taking off. And you kind of seem to be saying, well, it was a little bit surprising. But gosh, is it really that, guys like you, I mean, if you go on CNBC or you go on any of the shows, Bloomberg, and I'm sure you've done these things over the years, it's all about sound bites. You don't get a chance to really elaborate and tell people the thinking, the thought process behind your life and your career and your work.
I think that's right. I think that what you find is that you go on these shows and it takes a lot of work to get there. And then what they do is they'll ask one question and they'll say, bam, I got to go to a commercial break. And so you have to sort of condense everything into something pithy and quick. And at the end of the day is that the world is not, can't be explained with pithy and quick.
Yeah, that's for sure. I tell you, I wanted to jump right into something though that I thought was great. I was checking your blog out and I saw this passage, and I'm going to jump around on you today, and I've got a bunch of different topics, so it's not going to be linear fashion, but I just love this one excerpt. And you were talking about why you like trend following as a core strategy. And you mentioned that it's very difficult with fundamental analysis because of noise. There's noise in the data, but there's noise in prices as well. But you said prices are primal to determining return. There's no ambiguity about what the data is saying when I'm long the markets and prices are trending lower. But I've never seen anyone use the phrase primal with prices. It's something visceral. It is it, isn't it?
Yeah, that's it. This is it. Is that you can't hide behind your forecast. You can't hide behind, you sort of say that the market's data has been revised, or, people haven't really understood what the data was saying, or you're trying to sort of understand what the Fed or central bank official is saying. This is that it's either right or wrong. If you're saying this is that if you're long, the prices have to go up if you want to be successful. If they're not going up, then you're getting a signal that's telling you something is wrong. And you could sort of say, well, maybe the signal is wrong today, but at the end of the day, is that you're saying is that prices are telling you exactly what you need to know. It's if you're long, you got to have them go up, and if you're short, they got to be going down. And if they're not doing that, then it's telling you a quick signal. It's just say you're doing something wrong.
Explain to the audience why you attach such a fantastic descriptive word. Why did you attach that word to the idea of price action?
Well, ultimately, what you're saying that what you're trying to do is generate returns. This is what you're trying to do with your portfolio. And then where do returns come from? It comes from the price action. It comes from the movement of prices. So you always want to go back to what are prices doing? to tell you what kind of returns you're going to generate. Those have to be connected. When you look at the last quarter or so, you look at the last year, you have all of these people talking about what is the Fed going to do, what are central banks going to do, what is the macro economy doing, and they spend all this time talking about in great detail all of this information. But it is primal to getting returns in your portfolio. The answer is no. You have to get the connection because you can talk about central bank behavior, but ultimately you have to determine what are prices going to do, and how are you going to position against those prices. And that's not only on, let's say, returns. It also has to do with volatility. Volatility is driven by the price action, which again is primal to how you position your portfolio. It also has to do with correlation. Is it how are markets connected? Again, prices are primal. Is that are stocks going up and bonds going down? What's the correlation between the two? So ultimately, you want to sort of say that you say you can talk all you want about fundamentals, but ultimately you got to sort of translate that or put it back into price space. You have to put it back into what is happening to prices. And so ultimately you have to go back to what's happening in prices to tell you what's going to happen to your portfolio.
I saw you're a fan of Gerd Gigerenzer. Prices are a great heuristic, aren't they?
Absolutely. And I met Gert years ago down at the University of Chicago. He just is one of the best thinkers in terms of decision making and how to sort of get at some of these complex decision problems. And his whole idea of fast and frugal decision making is so important to the investment world, which is constantly changing, moving very fast, and very complex. I think he's done a great job of trying to get people to sort of focus in on the idea that sometimes you got to use heuristics, sometimes you have to use rules of thumb, because that's the best you can do in a complex world.
I'm curious, you've had a long career with many different aspects, working within many different aspects of the trading, investing world. When did you have that moment? I'm curious if you were more classically trained in your thinking and your thought process as a young man. Did you evolve to this thinking that we're describing now, or was it something that you've always had? Talk about how you made your realization to come to this heuristic of price.
I grew up in Chicago, and naturally, so you get connected to the futures markets in Chicago. And when I was an undergraduate, one of my professors, said, "Look, I know you're interested in grad school, but why don't you just take some time and work for a while before you go to grad school?" And so he suggested I go down to meet some people at the Board of Trade. And at the time, this is when you still had the pits and electronic trading. Take the escalator up to the visitor's deck, and you start hearing the roar of the crowd, and then all of a sudden you look out over the pits and you see all these people waving their hands and yelling and screaming, and your initial reaction is either you're going to say, "I'm revolted by this, that this is pure chaos, and I don't want to have anything to do with it," or you say, somehow there's some process going on here. People are making decisions. They're trying to figure out what is going on in the world, and you sort of say, "I want to be a part of this. I want to try to figure this out." And I think I was part of that latter case to say, I'm hooked. And instead of spending all my time on the floor, went on to graduate school and studied formally economics. But I'd say that there's been a connection throughout my career of saying, how do you make good decisions? How do you process information? And how can you be able to, get some semblance of order in a complex world that's filled with chaos? That led me to sort of looking at different models and prices.
Were there any events or people, traders, other fund managers, academics, anybody in particular, or a particular event that allowed you to start down the path? Or is it just kind of a quick observation that you're talking about right there? Was there something that really pushed the passion?
I think that some of the professors I had in economics for my undergraduate sort of lit that passion. They just had this one professor in particular, his name was David Mirza. He sort of focused me on the complexities of markets. So then I'd sort of say, like, well, I think I got this understood. He would just look at me and sort of have a wry smile on his face and nod his head and says, why don't you think a little bit more about this? He and others made me think about, like, that the complexity in market is like peeling back an onion. Is it that you think you know something, you peel it back, you have one level of understanding, then you find that there's another level of complexity. And then so now you have to sort of say, given this complexity, how do you sort of simplify it? How do you get to something that is, when we talked about primal, how do we get back to the primal of just being able to say, what can I tell about the direction in price?
You know what's so interesting in my observations in the last 5, 10, 15 years is it really seems like that so many of the great practitioners, maybe it's not as much from the guys that started in the 70s and early 80s, but then again, a guy like Bill Dunn had a hell of an educational background. But it seems like today, so many people are going very deep academically, getting these very strong theoretical foundations. But when they come back to execute and apply it, I think sometimes the audience or maybe investors or even other people that want to be like the latest or greatest trader out there, they imagine that once you have this phenomenal educational background, that the strategy must be just as complex. But the reality is once you have that complex education, you're actually coming back, as we're talking in this conversation, to something more simple and digestible.
Right. Absolutely. I think that there's a lot of focus on, for example, what is the equity risk premium? What's the term premium or bond premium? And the focus on what are the factors that drive prices. A lot of those factors don't change much from day to day or week to week. So you say, like, okay, the equity risk premium might tell me that the market looks rich or it might look cheap. Okay, but that lasts for a fairly long period of time. Now you have to decide every day when you walk up to the market or you walk into your trading room, say, what am I going to do today? So, and the only thing that you have that's consistent every day is price. And I think you look at commodity markets, is that you look at the pure commodity markets, you don't have a lot of information. You might get grain reports once a month. You might get a little bit of other information, but you don't have this constant flow of new data or new fundamental data coming in. So you're still left with prices. And then the way I view this is that prices are still the aggregation of everyone's opinions and the amount of dollar votes that they're bringing to it. So that if there's a big trader that has an information advantage relative to you, what's he going to do with his information advantage? He's going to go to the market, and if he thinks prices are going to higher, he's going to buy. And what he's going to do is his buying is going to start to push prices higher. You don't have to be the first mover. If you're a good close second mover or close follower, you could still be able to make money.
Let me read a couple sentences that I saw that you put out that I just really like. Fundamentals and risk factors change and may tell me something about what may happen in the future. But if I follow a base case that trends will continue, I will likely have a performance tailwind to help. A base case that trends will continue. Now, to the uninitiated, they might think, well, I need a base case that trends will continue. Why don't you explain that, Mark?
Well, I like to believe that when you look at prices, is that if the trends are going higher, and you're long, that's a great tailwind. That's always working in your favor. And in some senses, that price is telling you something. It's telling you that, and without being sort of trite, there are more buyers to sellers. That the preponderance of weight of other people's opinion is that prices are going to go higher. You want to be with that flow, and you can sort of say, well, maybe I have a slightly different opinion, but now you have to sort of say, how does that opinion weight against the flow of everyone else in the market? And so you sort of say, I always want to be with the flow, and I want to learn to sort of use that as my sort of tailwind. I want to use that as my base case to always sort of be with the flow.
The idea that so many people, investors, perhaps other portfolio managers, many people base their thinking on markets with the idea that you can know what's causing a price to move. Maybe there's a few savants on the planet that have figured things out, and they have enough muscle behind them, and enough dollar muscle, and they can do certain things. But I think for most mere mortals, trying to know what caused the price move, doesn't that really that distracts you from what the real objective is? The objective is we know there's price moves, we know there's momentum, we know there's trends. It's not going to necessarily happen all the time. The object is to try and capture some of that consistently and add it up to performance. That should be the goal, right? Not the why questions don't solve it.
I've been trying to figure out what are the factors that drive markets for decades now. And just when I think I've figured out one, then the world changes slightly. And I will tell you is that ex post, after the fact, I'm a pretty good forecaster. I can tell you after the fact. I can tell you what drove markets most of the time. It's trying to figure out what will happen on a go forward basis is really tough.
It's even like I saw something in your writing recently. You were talking about the notion of QE and monetary policy, and you said, well, hey, is there going to be more QE? But are we really at the point where any more marginal increases in money? I mean, it's going to be a limited impact. But again, as you discuss this, I perceive it as you discussing what's going on operationally, but you're not trying to say that my description of monetary policy and the idea that there's going to be a diminishing return, diminishing utility, you're not necessarily saying that translates to my name is Mark and I'm now making a bet that based on this understanding of monetary policy, and I have a certain foundation, a certain background, I'm now making a bet that some market is going to go the certain direction that I think. You're just describing the playing field, but not saying where it's going to go.
Yeah, and I think it's important to understand the environment you're working in. You have to understand the world you're living in, and so that's critical to have that core understanding. But that doesn't always mean that you're going to take that core understanding or what your view and translate that into action all of the time. This is it. But it does tell you is that, okay, if I believe, for example, that there's diminishing returns from, quantitative easing, it tells us is that then any given impact or is going to be less clear. So consequently is that I got to look to the market prices to tell me what's going on.
Tim Tanko at your firm has been responsible for connecting us, and he connected me with Perry Kaufman, who's also at your firm. And, I had a great conversation with Perry. And I think one of the interesting things is this little, this acronym that I saw in your firm's writings, VUCA, volatile, uncertain, complex, ambiguous world. I mean, that just looks like a big, messy ball of yarn going in every which way but loose. But that's the reality that we live in, isn't it?
Right, and we took that phrase from the Army War College when they tried to train officers on how to deal in combat situations or to train officers in warlike situations. They said what you're going to be facing is VUCA, this volatility. You're going to face uncertainty. Is that there's going to be complexity and ambiguity, and they say, like, how are you going to be able to deal in that environment? And so it's not always the smartest guy who's going to deal with it. It's the person who can sort of recognize the environment that they're in and sort of adapt and change. And I always like the phrase from Mike Tyson is that every strategy is going to work until you get punched in the nose. Then the strategy goes out. You got to sort of figure out what to do next.
In the context of portfolio management, give a few seconds or a minute or two or whatever to define, in the context of portfolio management, the notion of volatility, uncertainty, complexity, and ambiguity. I mean, they're terms. We can all look at the precise definition in every dictionary, but why don't you define it in terms of markets and portfolio management from your perspective, those four that make up VUCA?
When you believe that the world is you're in a VUCA world, you want to go back to sort of simple heuristics, simple, fast, and frugal methods of making good decisions. And this is what we talked about earlier. So that means is that I can't sort of always rely on some fundamental world view that say that this is how I think the world operates, and the world is going to have to conform to my view of the world. The reality is that you have to adapt and conform to the environment you're facing. So if there's high volatility, there's more noise in prices. So you're going to have to adjust to the fact that your signals aren't going to be as certain. When there's more uncertainty, which means that you can't measure the volatility, you can't measure what the impact of certain events would be. You're going to have to sort of say, I got to look to prices again and the behavior of others to tell me, what the market is going to do. When there's ambiguity where I just can't measure, what is going to happen because it's just hasn't happened before. Well, then again, is that I have to sort of look at the, weighted average of all of other people's opinions. Ambiguity and complexity is when we're facing questions that we haven't been able to, go back in the past and use some past reference to tell us what's going to happen in the future. And that's what we're facing, especially, in the world today, for example, is that if you looked 20 years ago, about, unconventional monetary policy or quantitative easing, we didn't have any sort of real quote unquote history to tell us. So we're feeling our way along, and that means is that you've got to use other methods to try to help you understand how markets will behave.
As I say this, when is the world not volatile, not uncertain, not complex, and not ambiguous? It is always, and if it's not always, then the real trick would be, well, hold on, we know it's going to go back to those points and those descriptors at some point in time, so you have to be able to transition. So the reality is you have to be able to prepare for the VUCA world at all times.
Right. In fact, now you're getting back to the sort of almost, we say, the zen of trading and zen of portfolio management. We're always going to be facing uncertainty, or we're always going to be facing a VUCA world. And that's what causes prices to move, is that if we knew with certainty what the world is going to do and how it behaves, then prices are going to be fairly much, pretty static. They're not going to move around. In fact, when prices move or diverge, it's telling us because something new is happening. The world is changing, or the equilibrium, or the markets are out of equilibrium, and they're trying to move to a new environment or new price equilibrium.
You enjoy, though, the process of trying to pull absolute returns from this VUCA world. You enjoy that process.
Absolutely. How can you not enjoy the fact that every day you wake up and you have to try to figure out what is happening somewhere around the world, and can you be able to play this game against everyone else? Now, the fact that I feel more comfortable using quantitative tools and models, and my partners feel very, very comfortable with that, where sort of say, we're very comfortable with using price-based modeling. It doesn't change the fact that we love to get up every day and play the game.
Yeah. There's a certain passion to it. I mean, sometimes I think everyone gets caught up in, hey, we might have found a way that can make more money than the quote averages. But the reality is, for the practitioners, for the trader, for the investor, for the person that's doing it, it's not just about the money. There's a certain, yes, of course, it's about the money. That's what investors care about, and you have to deliver. But if the money alone drove you, that's probably not the most solid of foundations. The passion is huge.
It's all about trying to figure out what drives markets, or trying to understand this complexity. And whether it's a scientist who's working in chemistry, whether it's a historian who's trying to look at some historic event and trying to ascertain what really happened, is that all the people who are scientists at heart, or anyone who wants to do deep thinking, is always trying to sort of say, how do I get a better understanding of some complexity of the topic that I'm working on?
Over-diversification. I don't think on my podcast I've discussed the notion of over-diversification. Too many markets, following too many markets. Talk about the idea of over-diversification.
I think that this is one of the things that we've sort of grappled with the models that we've been building more recently. The fact is that if you trade everything and have a position in everything, you're only going to get the market rate of return. Is that what you really need to do is to sort of cull out those marginal trades, cull out those marginal opportunities, and try to focus or be more concentrated on those where you think that you might have some advantage, or you think that you have some way in which you can exploit the market. And I think that everyone talks about diversification, and you need to have diversification. But at the same time, is that if you continue to diversify, there's a point of diminishing returns.
Yeah, it just becomes an index, right?
Yeah, you just become an index. And so I think that people have to understand this, is that when you want to diversify more and more, what you're telling yourself or what you're telling the market is that you have less and less comfort in the information advantage you might have.
Less and less skill, perhaps, or less models that don't operate as nicely as maybe other models.
Yeah, but the more you diversify, the more you're saying, I don't know what's going on, and then you're going to end up with back to the market portfolio. And I think that there's also, when you get into this diversification issue, and I think that it's one of the things that I've focused in on, this idea of style differences, is that you can diversify across asset classes, but in troubling times or in turbulent times, all the correlations start heading for one. So the diversification you think you have, you don't when there's times of trouble.
Talk about also, as we talk about over diversification, the notion of dynamic allocation. So you're working under the idea that let's enhance the chance of being rewarded for the risk taken. So that ties into the notion of being over diversified, doesn't it?
Well, no. What you want to do is you want to say is that you want to look. You want to have a sort of a large landscape. You want to look at a lot of different opportunities, and then you want to sort of be able to rank them. And that's what we're trying to do now with our models. Is to say, look at the total set of opportunities, and then rank them by some criteria to say, okay, which ones are the best. And then you sort of say, let's focus our dollars at risk into those opportunities that we think will have the highest chance of success. Doesn't mean that we're always going to be right, but you just want to say, how do I sort of get the odds more working in my favor? So you want to try to balance diversification across different asset classes, but within the asset class, try to find the best opportunities you can.
Years ago, I remember a presentation when you were with JWH, convergent versus divergent. And I had Catherine Kamensky on my podcast recently, and she was talking about it in her new book. But I would love for you to kind of explain it from your perspective, because I think you have been talking about this, and you mentioned, I've not mentioned this actually, the name of your new firm, which is the idea of, is the best way to describe it, both sides?
Yep. AMPHI Capital Management is Latin Greek for it means on both sides of an issue, and so we want to look at both return and risk. But at the same time, is that what I tried to do, and when I started thinking about how markets operate, I want to try to sort of say, and styles differ. I want to take it at a higher level, because most people sort of say, when you think about alternative investments, well, you need to buy alternative investments because the correlation is low relative to equities or to fixed income. And that's true, and that's important, but we know the correlations change. So you want to look at a higher level and try to say, like, what is the essence of different hedge fund styles? And what I try to do is break it into two parts. I call and it's based on your world view or macro view. And one is that you could either be a divergent manager or a convergent manager. And so I'll say the convergent manager says that the world's a pretty stable place. It's knowable. We can form rational expectations, and in some senses is that you think of yourself more as an arbitrager, or markets get out of line. I want to try to sort of settle the stuff that seems to be out of line on the high side, ride it back into equilibrium. So everything about markets or your style is convergent. Okay. On the other hand, a divergent trader says, market's pretty unstable. This is that we can have disequilibrium moves. We have dislocations. We may not know exactly what's happening in the future, and so markets will move from one state of the world to another. And so consequently is that you want to be able to think of how do you make money from mean fleeing strategies, which could be trend following. So you want to look for dislocations in markets. So in some senses, that when you build a portfolio of alternatives, you want to think about, well, maybe I need to have some people who are convergent, who are more arbitrage-like. And then I also want to have some people that are divergent, because they're going to make money if, let's say, that there's a tail event or there's going to be some dislocation in markets. And I think managed futures is a nice divergent strategy.
And as you mentioned managed futures, one of the key benefits is this notion of dealing with tail situations, rare events. But rare events, and I've seen this in your work, rare events, tail situations, are not so rare, actually. And I saw you kind of doing a book review on the improbability principle. Why don't you talk about the improbability principle in statistics and the notion that rare is not so rare, actually?
Everyone talks about black swan, tail events. They talk about, market bubbles are so unusual, or big dislocation of the market unusual. Is that if you look more and more at the large amounts of data, what you find is that the chance of improbable events or unlikely events are more likely. When you look at the law of large numbers, what you're going to say is that it tells us is that we have less sort of uncertainty around the mean of the distribution. But at the same time is that the chances that you can actually have a big move is greater. So what we have to accept is that the world and markets can face tail events, and you have to be ready for it. And I think that some people have talked about crisis investing, but at the very least is that market participants, investors, are going to be surprised. You're constantly being surprised. In fact, if you look at some data from some banks, they now have surprise index of surprises from fundamental information, and they sort of track the surprise index. This is that markets move because we get surprised. And so those are all they may not be large tail events, but we're constantly having events that lead to dislocations.
I think a great example for that currently for the audience to think about is the price of crude oil. I think anyone that would try to say a few months back that we're making a prediction that oil is going to move, nobody was paying attention. No one was going to, oil is going to do da-da-da. No one's really paying attention. But then when it goes down a certain amount, a significant amount, all of a sudden, I was just reading today, everyone's got a reason and why and this and that, as you say, in hindsight. But the reality is, how were you going to prepare for the notion to make money as oil unexpectedly drops a significant amount in price?
And this is where we'll call it a divergent strategy, like trend following, can actually work. Is that you not that you blot out of your mind what is going on in the fundamentals, but you sort of say the market is telling me that prices are going down. There's momentum going down. And my signal that I'm extracting from the noise of daily trading is telling me that prices are going down. I should be, or at least if I want to have a tailwind in my strategy, I should be short the market. As you look at crude as a perfect example, is that, think about it, is that you get some people say, well, the reason why crude is going down is because we've got a lack of aggregate demand around the world. And you got other people who say, no, this is all shale oil. It's a supply shock. And then you've got other people say, well, this isn't going to last because we know that OPEC is going to do something different. So in some sense, part of when we talked earlier about divergent trading strategies in a VUCA world, there's this view from a professor in Stanford, as Mordecai Kurtz, and he talked about what we call rational beliefs. They're different than rational expectations. And rational beliefs tell us is that we can have stories that are very believable and are very credible and make perfect sense, but we don't know for sure whether that story is going to be true until after the fact. So we can all have rational views, but that doesn't mean that they're all going to be realized and they can't all be true.
And we don't have unlimited money.
Right. You don't have unlimited money to impose your views on the markets. And in some sense, part of trend following and part of using price information is saying is that I can't impose my views on the market. All I can do is try to sort of extract what is the market telling me.
I think another angle that we can dive in on this subject, Mark, the notion of systematic versus discretionary. When you, myself, anyone sits down, I want to build a model. To execute that model, let's say you build it, I guess you could execute that model from a discretionary standpoint. And obviously, when you're building a model, certain discretionary decisions go into it. But there's a tremendous benefit to executing a model systematically, isn't there?
Absolutely, and I sort of view that the most important thing is if we're in life and in investing, is you have to say, know thyself. And if you sort of say, look, I know I make mistakes forecasting. I know I might have behavioral biases. And so what I can do is I can impose discipline on myself with a systematic approach. And I think that that's the most important lesson, is imposing, good behavior, on the fact that, generally you say we're going to have decision biases. And, I go back to, Ulysses when he wanted to listen to the sirens. He had his crew lash him to the mast, because he said, I don't trust my behavior as we get close to the sirens. So I got to sort of say, I got to impose some type of rules or discipline upon myself. And the discipline I'm having is that I'm going to lash myself to the mast. So in some senses, that risk management, when you have structured rules of risk management, you're saying is that I don't trust myself when bad things happen to my portfolio. So I'm going to put rules in place to limit how bad things can get when they work against me.
We've talked in this conversation, there is momentum everywhere, but momentum does not occur all of the time. And I think what I love about having these conversations with people like yourself, you're not trying to, put a round peg into a square hole. You're saying, look, we have to build a model that's adaptive to this terribly uncertain, complex, ambiguous world. We just don't know what's going to happen. And that momentum just can't be, I think, even though you can tell people, and I've seen this, even though you can tell people about the notion of trend following, they ultimately still want you, and I always see this in the press clippings. If you see a period of time, for example, where trend following traders have a drawdown, which is completely expected. Anyone that knows anything about this subject by now knows who doesn't have a drawdown. Warren Buffett has drawdowns. But there's something honest about this conversation that I still think in mainstream media, this topic will get broached a little, but I don't know. Do you think it's just too in-depth of a topic to put out there in the mass media? So everyone stays to these, as we mentioned in the beginning of this conversation, they stay to the sound bites and whatnot. Because the notion that it doesn't happen all the time, and you honestly tell people that that's the way the world works, you would think there'd be a certain amount of trust there, but I still wonder how much acceptance there is.
In some senses, is that people actually don't like simplicity. Some senses is that if I lose money, is that if I just sort of said our portfolio, had signals that the momentum was higher and the market reversed and I lost money. This is it. They say, yeah, but why? Now, if I came in here and say, here's what the central banks are doing, here's the new data that was happening, here's a good explanation, I can go on about 5 to 10 minutes about what the story is for why I lost money. They somehow feel more comfortable with that. But the reality is that I think that you want to try to keep, in essence, a simplicity. And this gets back again to our whole idea of primal. This is that I lost money because I was long and the market price declined. Now, what we're saying, if we're a quantitative modeler, is say, we've looked at data for years and years. We've looked at thousands of data points across, many, many markets. And they sort of say, when I see certain patterns or if I see certain events, they say the odds are in my favor. But even if my odds are in my favor, that doesn't mean that I'm not going to lose money at different times. And it's just, now that's a very good, simple story. People sometimes want they want more complexity there. They want a deeper story.
But when it comes to complexity now, your firm is not afraid of having multiple models. It's not necessarily just one model.
No, you want to have multiple models, and in some senses, that when you think about that, is that that's the way you can get diversity. And I always think of diversity on 3 dimensions. And I used this for years. I call it, you want to have diversity in style, timing, and markets. So in shorthand, I call it my STM approach. And you can think of the markets on those 3 dimensions as a cube. And what you want to do is you want to make sure that you fill each, let's say, space in that cube with some type of model or strategy. So for example, this is that, I want to trade different markets. I want to trade bonds, stocks, and commodities. I want to trade different timing. I want to have some shorter term models. I want to have some that are going to be more medium and long term. And then finally, I want to have different styles. So I might have, pure trend following. I might have something that's a little bit of pattern recognition that's looking for different phenomena. And I can get just as much diversity on style and timing as I can for markets. And I think sometimes people forget that is that I don't have to worry about just diversification between stocks and bonds. I can also talk about diversification of style of managing and timing of whether I look over a short horizon or a longer horizon.
Risk and return. So many people think of risk as something to be avoided. And then when they think of returns, they don't necessarily attach the idea that you are going to risk the loss of capital to possibly get the return. And perhaps you can make the argument that the more you're willing to risk, the more you're willing to lose, the greater your return might be. So, larger returns don't necessarily grow on trees without larger risk, but you don't get return without taking risk.
This is constantly the issue that we have to, if you would say, what's the number one issue of education with clients is the trade-off between risk and return, and the fact that you're only going to get higher return if you take on more potential risk. Now, even if you say you want to reduce that risk because you want to have the odds in your favor that your return is going to be a multiple higher than the risk you take, is that if you don't take the risk in the first place, you're never going to get that return. So we constantly have clients that might sort of say, well, I'd like to have double-digit returns, single-digit risk, and I'd like to make sure that you never lose more than X percent in a given 12-month period. You never have a drawdown that's double digits. I'd like that too.
It's not the way it works.
Our view is that we're going to try to only take, ex ante before the fact. We're only going to take, opportunities that we think that we're going to be able to have the chance of making a return that's going to be, multiples higher than the risk we take on. But ex post, I can't guarantee that.
Yeah. I hope the audience appreciates, and they can always do a little Google homework, but you've got a wealth of experience. You've seen some of the best traders of our generation up close and personal. You've had a chance to participate. It's a really cool story. I mean, I wish you well with the new firm. Like I said, Perry, was a great conversation. I got a lot of great feedback on that. I think people really enjoyed it. So, Mark, I appreciate you taking the time today. People can find you guys at AMPHI Capital, correct?
Yes, AMPHI Capital. We're new, but we probably we've got decades of experience between all of our partners, and I think that we think that there's a great opportunity right now for divergent strategies and systematic managers. And you look at what the environment is right now, is that you've got low volatility, you've got a lot of changing policies, and you've got a lot of uncertainty out there. And I think that that's a great opportunity to start a managed futures global macro firm. It's a great opportunity to look at systematic investing, and I think that this is something that's going to do very well over the next couple of years.
You're not trying to make a prediction as you say that, but look, everyone can look at the VIX and some of the volatility measures, and all you can see is compression. And unless one believes, and that compression seems to have gone on for a long period of time, and usually these things shift and change and something else unexpectedly happens.
Yep. When you have volatility compression, you have complacency, and we all get used to the most recent environment. And so if we have a low volatility environment, if you sort of say that, okay, stock market is only going in one direction, the Fed is always going to provide liquidity, so that you sort of get used to that environment, you start to become complacent. And complacency is the opportunity for the time when you're going to have your biggest dislocations. And that's, in some sense, is the essence of, I know you've talked to people about crisis investing, is that when you get down to the essence is that why do crises occur? It's because of complacency, and complacency occurs because, volatility or the environment seems to be overly stable.
Well, that's where right now everything's stable. Nothing to worry about, Mark. It's all going to be okay. Nothing to worry about.
That's where I want to. When no one's worrying, that's when I worry extra. And this is an environment I think is good for our type of strategy.
Hey, Mark, thank you for coming on today. I really appreciate you taking the time.
I enjoyed it. Love to do it.
Thank you. I I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.